Hi, everybody. Kevin Reardon coming to you here from Shakespeare Wealth Management. We wanted to take a break and give you a market update and share some of our perspectives on what's going on here in the recent weeks. Many people have commented that these are unprecedented times in the market, and the reality is that's just not true. Is that through history, we've faced volatility day after day, week after week, year after year. It's really just an issue of what's causing the volatility in any given year. In fact, the chart I have in front of you, I wish it had gone back to 2007 and 8, where we were really suffering through a housing crisis and credit crisis. From that, May of 2009, General Motors filed for bankruptcy, a huge news story at that point in time. 2010, we had a Greek debt crisis that was hitting the markets. 2011, Standard & Poor's downgraded the United States debt from AAA. Huge story. Interest rates in Europe in 2012 went negative. We had a bombing, the Boston Marathon in 2013. Ebola, 2014. 2014, oil prices fell over 50%, something we're experiencing right now. All of these different events in recent history that have had short-term impacts in the market. But look at this red line. Look at the market work its way through all of these negative news stories. Fourth quarter of 2018, the market dropped 14%. Can we even remember what caused this drop? And then we all remember 2019, the positives that followed. In fact, if we go back, the S&P 500 has had 155 trading days in the last decade where it's been plus or minus 2%. So we're used to that volatility. The Federal Reserve has raised rates 9 times, and this chart's a little outdated. It's now cut rates 5 times since that point. We've had 5 quarters of negative GDP growth, and the government shut down 3 times in the last 10 years. So really some historic news stories. This corona flu is one more component in a list of things that the market will work its way through. Bull markets and bear markets, you'll see on this chart, bull markets, they tend to last quite lengthy and be very powerful on the upside. In yellow are the bear markets. And the takeaway here is these bear markets much, much shorter than the bull markets. And by the way, this decline we're experiencing now, very significant. It's down more than 20%. But the speed in which it's happened, it's a huge positive. Our experience is the faster the decline, the faster the recovery. Let's go back to the volatility we talked about. So this chart measures days when the market is plus or minus 2% in any given day. If we go back to 2008, 2009, we had 127 days of plus or minus 2% volatility, and then reasonably low volatility for the years thereafter. This chart ends January of 2020. Since February 1st, we've had 13 days where the market is plus or minus 2%. Keep in mind, I didn't say 13 days of minus 2%. Of those 13 days, several of them have been positive. Looking back to February 23rd, the week of February 23rd, 2020, we had the 4th worst week in the last 70 years where the market was down 11.5%. And if I had updated this chart last week to include last week, we would have had another negative 8% built in here. So 2 of the worst weeks in the last 70 years have happened in the last month. One of the key takeaways is that if you zero in on a bad week and you go fast forward a year later, on average, the markets have averaged 18.5% to the plus side. So a very good sign of what may be to come. This is a fantastic graph where if you zero in on the diamond here, each of these purple diamonds, this shows the low point in a given year. So 2009, the stock market bottomed out in, ironically, March at a negative 26%, finished the year at a positive 26%. a full 52% differential. 2010, minus 16%, but finished the year plus 15. Minus 17, finished a plus 2. So even though we're sitting here at a minus 20%, March 16th, 2020, that's not to say that's where we'll finish, and it's actually quite conceivable we could finish this year positive. So what do we do from here? If we go back the last 20 years and invested $100,000, that money would have grown to $324,000. Had we missed the 10 best days during that 20-year period, the return dropped in half. So the absolute worst thing to do at this point would be to pull money out of the market. And keep in mind, most of these really substantial up days happen immediately after the substantial down days. So it's really imperative that we stay the course at this point and keep the money invested, because the easy money, if you will, if the market's down 25%, it can very quickly get to a negative 15. It can have a positive 10% return literally in a few days. This graph is a little busy. Each color represents a different asset class, and it lists the top performer each year all the way down to the lowest performer each year. If I could just have you zero in on the purple color, this is a diversified portfolio similar to the portfolios we manage for many of you guys. And you'll see the diversified portfolio stays obviously in the middle of the returns each and every year. And so you can have the confidence that even though the stock market is down a fair amount, that's not to say your portfolio is trading lockstep with the markets. So let's share some perspectives. The first, downturns happen. You know that, we know that, they happen. We don't know if they're going to be caused by a credit crisis, a housing bubble, a technology bubble, a coronavirus, or whatnot, but they happen. We understand that, and we manage portfolios in advance based on that. So the securities we selected, the asset allocation we chose, the rebalance disciplines we deploy, all of those are taken into account knowing these realities of the downturns. As mentioned, the faster the downturn, historically, the faster the upturn. And the first few days of the recovery are the absolute most important. From our perspective, what's happening currently is the equivalent of an economic timeout. It's literally everybody saying timeout, and we think this is going to last 3 to 4 months, keeping in mind this started a month ago in mid-February. By the time we get to mid-May, we think the economy is going to be back to work and moving back up to speed. Panic, by the way, we have an absolute confidence vacuum right now. There is no confidence in the marketplace, and people are projecting. They're projecting the market's down 5% today, it's going to be down 5% tomorrow. And that projection is absolutely unproductive and unrealistic. Once panic subsides and that confidence vacuum goes away, the vacuum goes away, confidence will return. And with that confidence, the markets are going to move higher. I'm not sure how quickly we'll get back to zero, but I do know those first few weeks we'll see substantial recovery. And this is why I know that. From a positive perspective, we have historically low interest rates. That will stimulate growth. We have absolutely low energy and oil prices. That will stimulate growth. Low inventories are an absolute positive. Once people start ordering, manufacturers have to begin producing again. There are not large inventories out there that need to be worked through first in order for manufacturers to begin production. And we absolutely have a strong banking system. Coming out of 2009, the banks were facing additional regulation, and with that regulation came healthier balance sheets, better loans, And in addition to this extremely strong banking system, there's more and more and more alternative financing options out there for individuals and corporations. There is no shortage of money in the marketplace today. We could not have asked for a stronger or healthier economy pre-virus. We had an absolutely strong and great economy in January. That's a huge plus that will help us work through this situation more quickly. Your holdings are absolutely diversified. Not only are we not sitting on a ton of bank stocks coming out of a credit crisis, and we're not sitting on a ton of technology stocks coming out of a tech bubble, we also own bonds. And so those bonds have done extremely well through this downturn, which will let us rebound faster. The scenario we're facing now is not a terrorist attack, which would have been, I think, potentially more significant than the corona flu that we're facing. Absolutely no damage to our infrastructure. We are fully intact, both here in the United States and globally. And contrary to public belief, our healthcare system is completely capable of handling what can be thrown at it. Some health positives looking at the corona flu. This virus is not impacting the young and healthy, and we have a young population, so the U.S. will be less affected than countries like Italy that have a much older demographic population. In addition, the young and the healthy are typically the ones out making the money and the ones more likely to be out spending the money. The fact that this corona flu is not impacting the young and the healthy is a double benefit to the economy. The United States has far better hygiene than the rest of the world, if only because we have running water and flush toilets, along with all of the hand sanitizers and everything that goes with it. The preventative measures that have been taken are extremely significant. We can't sit here and argue that more measures need to be taken. The measures that have been taken are significant and will get past this corona situation that much quicker. Technology is a huge asset. It allows everybody to work remotely. There's obviously schools that are studying remotely, in session remotely. Again, a huge advantage. The realization this virus is modest. When comparison to the general flu, the numbers in the denominator of the virus in terms of people that have it are massively, massively understated. The real fatality rate is dramatically lower than what's advertised. Nonetheless, the numbers that we're showing will continue to increase. The more people we test, the more people we'll find. The important thing here is that the rate of change is already decelerating. If you have 100 people with an infection and it grows from 10 to 20, that's 100% change. If you have 100 people and it grows to 110, that's a 10% change. Even in both instances, it's still not fair to project those ratios. Each new person will lower the rate of change. So where do we go from here? First, clients who are already in withdrawal mode, i.e. those people who are retired, we generated your required distributions in early February before any of this took place. And so from a withdrawal standpoint, we have money, cash, sitting, waiting for your spending needs. In addition, we have bonds in a portfolio that have weathered this storm extremely well. So if you need money, we can access those funds without selling equities at reduced prices. Rebalancing is happening now. Because we own bonds in portfolios, the bonds are up, the stocks are down. We are in the process of selling some of your bonds and buying some additional equities. We'll continue with tax loss harvesting, selling securities in taxable accounts that are at a loss, so we can put those in our pocket and use those against future gains. So in general, the concept is sit back, enjoy the ride. I don't mean to be flippant there. as easy as it is to project where will we be in a week, in a month, if you're thinking that you're waiting to make a decision until things get better, that's not how the stock market works. If you had cash to invest, now is absolutely the time to be looking to put that money to work. Yes, the market could go down more from here, but when the recovery starts, it's very likely to be fast and furious, especially the first phase, the most significant phase of the recovery. All right, so that's all we have for now. Any questions, always reach out to us. You can reach us 262-814-1600 or via email, info@shakespearewm.com. Look forward to hearing from you in the near future.